We are convened meeting of the Henry County Economic Development Commission, the RDC, certain members of the County Council, and this is to inform you that the County Commissioners do have a quorum at this meeting.
My name is Corey Murphy, serve as president of the Newcastle-Henry County Economic Development Corporation and also staff to the Henry County Redevelopment Commission. Appreciate the bodies gathering here today for a work session to talk about the proposed incentive and timetable related to a potential expansion of the Boar's Head processing facility. The Boar's Head processing facility is located on County Road 400 South in Franklin Township. So it's on the south side of 400. The initial processing facility, they located here in 2014, broke ground in 2014, and were operational in 2016. The proposed expansion represents approximately 136,000 square foot facility. And if you were in an airplane or flying a drone above their processing facility, it is immediately south, connected to their current processing facility. The investment is approximately $126 million. And the new jobs are 120 by June of 2024, and the wages are $19+ an hour, and that hourly wage excludes the benefit package. Joined with you today are the county's professional team or professional advisors. They're going to talk about the requested and proposed incentive. And so we have Lisa Lee with Ice Miller, and we have Jason Simler from Baker Tilly. And so I'm going to turn the microphone and the floor over to them to walk us through the process of what to expect, and then feel free to answer questions.
I think I got it now. But if you want to sprint over here and help me. Sorry. Again, I'm Lisa Lee with Ice Miller, serving as bond counsel to the county on this expansion project. So I'm going to go over really kind of the legal process and the public approvals and the different bodies that need to act in order to effectuate the incentive that I think Jason's going to talk about more of the numbers. Most of you were not around in 2014, but we did the same kind of incentive structure in 2014 for the original Boar's Head plant. We call them EDC bonds. That stands for Economic Development Commission, because that is the statute under which we can issue these types of bonds. Most bonds that you're used to, like general obligation bonds or bonds for your jail, lease rental bonds, those are all more governmental entity bonds in which you, as the governmental body, you oversee the construction of that project. It's subject to public bidding. You oversee the expenditure of the funds. The EDC statute is the only statute that allows you to actually provide the bond proceeds to a private entity. And it's not subject to public bidding. The legislative reason for that is that typically it is a part of a larger construction project, which is their overall expansion, because the incentive that you are looking to provide is not going to pay for their entire expansion. $126 million. So you're just a very small portion of that. So it doesn't make public policy sense for them to have to publicly bid that portion for which you may provide the incentive. You can put things in documents such as that they will use their best efforts to use local suppliers, et cetera, and we can do those types of things. But from an overall public construction statute, it doesn't apply here. So in 2014, we went through the same three public bodies. They have different people on them now that we need to go through this time. That's the Economic Development Commission, which is a 3-member commission that was originally created by the Board of Commissioners many years ago. One of those representatives is directly chosen and appointed by the Board of Commissioners. One is chosen by the County Council and then appointed by the Board of Commissioners. And then the other is actually chosen by the fiscal body of the largest municipality in the county, which is the City of Newcastle. And they have also chosen a representative, and Corey would know more, but all of them then eventually get appointed by the Board of Commissioners. That body really is only a recommending body to the county. What they do is they hold the public hearing on the project. So they take public comments. They have a notice at least 10 days ahead of time. They hold a public hearing. There is a project presentation, so we will have company representatives at that hearing, and then take comments from the public. Then the EDC will make a recommendation through a resolution whether or not to recommend to the County Council that they move forward with the incentive and adopt the bond ordinance to allow us to effectuate the incentive that we're going to talk about. Even if they don't recommend it, if they were a thumbs down, the County Council could still ultimately approve the bond ordinance. And also, if they were a thumbs up, the County Council could also choose not to approve the bond ordinance. So that's what I mean by they're purely a recommending body for this process. Okay. Then there's the Redevelopment Commission, and the Redevelopment Commission is the commission that you recognize as a 6-member, 5 voting members, and then a school board representative. That actually is an ongoing commission that oversees all of the county's TIF areas, all of the tax allocation funds, and the use of those funds, obviously according to an economic development plan, which, if it's amended, has to be approved by the Board of Commissioners. So at one point, the Board of Commissioners has approved everything that is in the Redevelopment Commission's economic development plan. At this point, we're not suggesting any amendments to the plan. Obviously, improvements for Boar's Head capital improvements is already in that plan, and so we don't need to do any amendments at this point. But the Redevelopment Commission would actually be the body that pledges the tax increment, and I'll let Jason go into the details of what that pledge particularly is in this case. It's less than what it was in the first go-around, but the Redevelopment Commission is actually the one who pledges the tax increment to the repayment of the bonds. And I can tell you that we're not proposing that anything other than that particular pledge of tax increment be pledged to these bonds. So no other county revenues, certainly no property tax backup, no income taxes, nothing like that is proposed to be pledged to these bonds. And then you have the County Council, and the County Council is the body charged with adopting the bond ordinance as the fiscal body of the county. So we'll be looking for, and I had Corey pass out what we call a procedural timetable to all of you, and I'll go through that a little bit fairly quickly as I just kind of tell you who these bodies are. But the County Council has the overall say, thumbs up or thumbs down, on whether or not to issue bonds to provide an incentive for the expansion of the Boar's Head plant. So looking at your procedural timetable, Corey provided a project introduction to the council back in late January. We're getting our bond parameters from Baker Tilly as the financial advisor, and they're working with the financial advisor for Boar's Head to confirm all of their numbers. Then we will start sending out draft documents to the working group. So just as the last time, there'll be a financing and covenant agreement, which is the agreement between the county and Boar's Head as the user of the bond proceeds and the company building the expansion. And that'll just kind of have the covenants and agreements as to what they're going to do and what you're going to do contractually once these bonds are issued. There'll be a trust indenture, which is the agreement between the county and a financial institution that is serving as the trustee. What I want to say about that document that's important, I think, to this group, you heard me say that under your normal governmental bonds, it's your governing bodies, whoever is the issuer of those bonds, that oversees the expenditures of those bond proceeds, oversees the construction. And here, this is the type of bond issue in which you can provide the proceeds directly to the company as a private entity. However, we do that through the trustee. So when the bonds are issued, those bond proceeds will be deposited with the trustee chosen by the county that you're comfortable working with. And then that trustee will pay your professionals the cost of issuance out of the first line of the bond proceeds, so that there's no bills that will come to the county outside of the bond issue. But then for the company to actually draw down funds, they have to provide a disbursement request form. They have to provide evidence of the expenditures and the payment of those expenditures, whether that's materials being received, whether that's construction costs. They have to provide invoices and other proofs of payment to the trustee before the trustee will disperse those funds to the company as a reimbursement. So there is a fiduciary body in charge of overseeing the expenditures of those funds. We can add an additional signature requirement of someone from the county to that disbursement request form if you want someone to have to go out and make sure those materials have been received, or that construction work has been done that is being charged to the bond proceeds. So there is oversight. It's not just that we put those funds into an account of the company and that you don't have any oversight of that. So you could always get reports from the trustee as to what has been expended and for what expenditures, okay? So that's the trust indenture. That's an important document. And then there's a bond purchase agreement, which is really the agreement between the county and the purchaser of the bonds. Just like in 2014, the company is going to be purchasing these bonds, so you're not marketing them to a third-party financial institution. The company will bear the complete risk that the pledged tax increment is not sufficient to pay the debt service, and if it's not sufficient, they just don't get the rest of that annual debt service payment as the purchaser of the bonds. As I mentioned, there are no other county revenues, assets, taxes pledged to pay this. If they don't generate the tax increment that is being estimated that they're going to generate, it won't pay 100% of the debt service, and that's on them. Okay, so they'll bear that risk.
Would you say that one more time?
Yes, if the tax increment is not sufficient, the company, as the purchaser of the bonds, will not get 100% of the debt service payment for that year. So if they fail to complete it on time, which I believe is by the end of 24, or they don't build as much as they thought they were going to build, or it's assessed less than what was estimated to be assessed, the tax increment very well may not be sufficient for the size of the bonds, and they just do not get that full debt service payment. No other revenues pledged.
This might be evident to everyone else but me, but what is the benefit to Boar's Head as a private company in entering into agreement with the county to have
To do this.
the county involved with these bonds? I would think they could easily just go out and finance their own building. What is the benefit to having us involved?
Two things. The biggest benefit to them is getting the tax increment pledge over it's not 25 years here because this TIF area has already started its expiration. So if they were to go out and get private funding, you cannot pledge TIF to the private funding. So this is a way of them getting a portion of their property taxes back over the life of the bonds. So they're not getting any cash infusion up front, any new capital infusion, because they're not selling it to a third party and getting new money. They're using their own money to buy the bonds and then using the proceeds to help build, the proceeds of their own money to help build a part of their project. So they're not getting any new cash up front. But in the semi-annual debt service payments payable from a portion of the tax increment, not 100%. They will get a portion of their semi-annual property taxes back. That's part of their incentive. So they get help on the operating cost side to get a portion of their property taxes back semi-annually.
So it's really reducing their annual operating cost
Yeah.
for the life of the bonds.
So that is the incentive, is for them to get the TIF pledge over the term of the bonds. Okay? And then as far as what we're looking at here on the procedural timetable, there are some upfront things, as I mentioned. We'll send out some draft documents for people to review, and then we're looking on February 24th for the county council to introduce the bond ordinance. We would be here to explain the bond ordinance, the provisions of the bond ordinance, answer any questions that they might have. We're not asking them to take action at that time, and if they have questions after that meeting, we're certainly able to answer those as well. We will publish a notice of the public hearing of the EDC, and then we will hold a public hearing of the EDC. It may not be on March 21st. It may be a little earlier than that. It just depends on schedules, but it needs to be before the county council adopts the bond ordinance, because the EDC has to make the recommendation one way or the other. And then we also have the Redevelopment Commission taking action to pledge the TIF to the project bonds of Boar's Head. So that's really, and then the council asking them to actually adopt the bond ordinance at their March 24th meeting. And then really we can sign, if all of those are approved, then we can sign a bond purchase agreement with Boar's Head, and we can do closing documents and actually have a closing where they provide 100% of the proceeds to the trustee, and then start putting in disbursement requests for project costs as they go along. They have asked for this timing in that they want to start construction as soon as they can, so they want to know that they have the incentive approved before they do that. Did I say anything wrong there? So that's from a legal perspective what we'll be providing to you and bringing in front of the public body. So. Any questions on that? Anybody, Debbie from the audience, have any? Nobody's raising their little hand, whatever that is. Okay. Take it away, Jason.
Again, I'm Jason Semler with Baker Tilly, and serve as your municipal and financial advisor. And as Corey and Lisa mentioned, what is being proposed to you for this expansion project is very similar to what we did in 2014 when Boar's had originally was located their facility here to the site. And I kind of want to talk about that a little bit, because of how that was structured does play a role in part of the incentive that we're talking about here. As mentioned, in 2014, there was about $12.2 million worth of bonds issued in September 2014. And that date is important because TIF areas created after 2008. The 25-year clock starts when bonds are issued. So that 25-year, we talked about numerous times, TIF areas, they do end at certain periods of time. Well, TIF areas that were created in 2014, such as the Boar's Head allocation area, it started in 2014 as a 25-year life. So it ends in 2039, 25 years from that date. So the bonds that we did in 2014 had a 20-year maturity. They'll be paid off in 20 years. These will only go out for 17 years, because that's all the remaining life is on that TIF area. So the bonds are going out longer than the existing bonds, but it's less than 20 years, because that's the life of the TIF area. And then after that, the TIF area will be dissolved, and all the assessed value that's there from the original investment, this expansion, if it goes forward, and any future investment, will pass through to all the overlapping tax units to help reduce rates in 2039. So I wanted to make sure that you're aware of that. We're not extending the life of the TIF area at all from its legal statutory requirement, but these bonds will go out longer than the existing bonds, but a shorter period of time than the original bonds because of the life of the TIF area. No, not under current law. So in 2039, the Redevelopment Commission will have no ability to extend it. The assessed value will automatically pass through to help reduce tax rates at that time.
You could, at that time, create a new tax increment area out there, but everything that's already there would be in the base, and you wouldn't collect TIF on it. So that would all go through to the overlapping taxing units from an AV perspective.
So one other main distinguish between the original bond issue and the incentive package and what's being proposed here is the original proposal, 100% of the tax increment was pledged towards those bonds. And the tax increment is generated from the facility and all the equipment that they invested in the facility. The original proposal that they came forward to the county that also asked for 100% of the expansion area plus any surplus from the original area. Right now, again, there's bonds outstanding. The bonds were structured on 100% of the tax increment that we estimated in 2014. They've actually invested more in equipment than what they intended. Tax rates have increased somewhat since 2014. So you're collecting more tax increment than what we projected. So you are generating more tax increment than you need to pay off the existing bonds. And that's accumulating in your allocation account. Their first proposal to the county was to ask for 100% of the new TIF plus any surplus that you're currently collecting. The counter offer was 75% of just the expansion. So we're still working on the actual investment. They're working with Jody, the county assessor, and what the assessment on the real property might be. But the only thing that we pledged towards these bonds is just 75% of the expansion. So 75% of the new equipment and 75% of the expansion of the existing facility. We've already talked to the company because we were worried about, equipment often gets commingled with the new equipment and the old equipment. We didn't want that to hurt the existing bonds. We also wanted to make sure it was easy to calculate that 75%. So the company has agreed to file a separate 103 form with the county. So they'll have the equipment that's in an existing facility on one form and then expansion on a separate form. So it'll be very easy for the auditor's office and us to calculate that 75%.
And that's one of those covenants, sorry to interrupt you, that's one of those covenants that will be in the financing and covenant agreement. So those are the types of things that we would put in that agreement to make sure they adhere to.
And that's important to protect you because as Lisa said, the only thing that we pledge towards these bonds is 75% of the tax increment generated from the expansion. So if they don't invest in the amount of equipment that they say they're going to invest, if the assessment comes in less, we're not going to be dipping into any of that existing TIF that you're collecting from Boar's Head or any other area to make that debt service payment. It's just the expansion. And again, if it doesn't come to fruition, then they just don't get paid that payment that year. So the bonds that will be issued, that will be and they'll close on, will be structured around the 75% of the property taxes that we anticipate they pay, and no more. And it will go out through 2039, which is again the life of the TIF area, which is about 17 years.
Jason,
Yes.
this is Susan Hoon.
Hi, Susan.
I'm just trying to make sure I understand. So these are questions other people probably know the answers to, but so all of the tax increment financing we're collecting right now, are we still paying? We're still using those funds to pay for the 2014 bond.
That's correct.
And when did you say that bond comes due?
In 2034.
In 2034. And so can you just,
2035.
okay. Can you explain again to me, so if this new bond is issued, which bond gets paid first, and do we expect excess funds? And I think some of it I was having some trouble hearing.
Sure. Well, when the Redevelopment Commission collects their settlement every 6 months, we'll work with Debbie and the Redevelopment Commission to distinguish how much tax increment was from the original investment and how much tax increment was from this expansion.
Okay.
And then we'll look at the tax increment from the original investment, and there's a bond payment due every 6 months, and if there's enough tax increment to cover that payment from the original investment, we'll transfer that to the trustee, and the trustee will make that payment. And then we'll look at the expansion taxes, and we'll look at 75% of that. And if there's enough to, we'll transfer that to the trustee to cover that payment. And if for some reason there's not enough, if you take 75% of the expansion TIF, that's all we'll transfer up to the annual payment. And if it's not sufficient to cover the annual payment on these new bonds, the bondholder just won't get paid. The company won't get paid.
Okay, so that this new bond will never get any of the tax monies created from the original investment.
Correct. Yeah, we'll structure it that way. That's the intent.
Okay, thank you.
And that 25% that is not pledged to the bonds, the Redevelopment Commission can continue to capture that and keep that as allocation fund to pay for additional capital projects that are in serving or benefiting the economic development area, or they could choose to pass through a portion of that. And that's a decision they can make each year.
And those funds won't be used for the original bond?
Correct. It will not be.
Okay. Thank you.
Indiana Gateway, so the Department of Local Government Finance has a reporting mechanism, and so the 2014 bonds show up as county debt. Can you address that?
Yeah, I can. Corey's right. Sorry, Corey, I forgot to mention that. These bonds will be issued by the county, so they are considered county debt. They will show up on Gateway as county debt in your annual debt report that the county has to file each year. We will include that. Standard & Poor's, whenever they ask for any debt of the county, we will include this just like we do for any other TIF debt that the county has issued. That being said, it does not count against the county's debt limit, and we've talked about that before. And again, there's no other security, no other revenues of the county that's pledged towards these bonds other than the TIF, but it is considered county debt.
So said a different way, if the taxes aren't paid by the bondholder, then the debt payment's not made.
Correct.
So this is could be described, and I might make Lisa nervous, but that wouldn't be the first time. This could be described as a self-funding incentive. In other words, we're giving the benefit of the company of their investment. But if they don't make the investment, then the county doesn't owe the bondholder anything.
Correct.
Thank you. Other questions?
I have a quick question. This is Susan again. I had been told that there was some state legislation that was going to be tried to push through about pulling back some of the tax increment financing revenues back to the state, which would reduce the amount that we can use to pay off these bonds. Is that relevant to this discussion at all, or likely that it'll go through?
This is Lisa with Ice Miller. I know what legislation you're talking about, although I can't remember the bill number. But it is a proposal from the Indiana Economic Development Corporation to allow the state to request a local government to implement a tax increment finance area. It's actually, Corey may remember some of these. It's much more like the old Creed and Technology Park districts, in which they also capture incremental sales and use taxes, but they can also capture real property improvements. I don't know if that's going to go through or where that is. It's not clear. They cannot do that over an existing TIF area, is my understanding. Obviously, that would impair outstanding bonds, and that's not something that the legislature can do. So if it goes through, it will be for a new type of area that's not already an existing area, and it's not clear whether they can require a local government to do one. But if they do, the state collects 90% of the real property TIF in that area and allows you to collect 10%. So we'll look at that and see where it is, but it does not impact this incentive.
I would also add another bill that I'm sure you're well aware of and following is 1002 and personal property, where that bill would eliminate the 30% floor that manufacturing companies currently have in place. So if that were to pass, the existing bonds were based upon the equipment having the 30% floor. These bonds are based upon equipment still having a 30% floor. If that bill were to pass, you look at your tax increment pretty much being cut in half for the equipment. Again, only thing that's being pledged is the tax increment. So if the tax increment is cut in half, the future tax increment, all that means is that the developer wouldn't get paid its full principal and interest payment due that 6-month period, because all it's pledged is what they pay. So again, kind of what Corey said, it's kind of a self-fulfilling prophecy. If they pay the taxes, they get 75% of the taxes back. If they don't, then they don't get 75% back. So again, even if that law passes for the purpose of these bonds, it would not impact the county at all.
Both of you and your respective firms work statewide. Is this a fairly common structure?
It's an extremely common structure. It's really one of the only structures available for developer-based incentives.
Maybe on the air of like repeating myself, but what risk to the county? What risk is there to the county?
I would say there's no financial risk to the county because, again, only the TIF 75% of the TIF generated by the expansion is pledged to the repayment of the bonds. So if legislation reduces the personal property tax they're paying, obviously they're getting the benefit of not paying as much personal property tax, but then it's not generating as much TIF, so they're not going to get it on the debt service side, and there's no other revenues that the county pledged. And I would say that the market recognizes if those bonds are not paid, that it's not really a default of the county. So it would not, I do not believe, and I'll defer to the municipal advisor, that it would have any impact on the county's ability to issue regular bonds for county projects in the future.
Yeah, I'd say that's correct. I mean, really the only risk is if you'd go through all the steps that Lisa mentioned, they approved the project and then for some reason the project didn't occur. But part of the agreement is that the developer would pay for all professional fees. So even from that perspective, the county's not out of any pocket.
So if the bonds are not paid, do they go after the company then? They go after Boar's Head?
Well, the company is the bond purchaser, so they would go after themselves. So there's nobody to go after. That's the other part that's like no risk. There's not a third party that would be looking to the county or the company. Boar's Head is buying their own bonds, and it goes back to your question as to why would they do that. That's so that they can get the debt service payments semi-annually over the 17 years, which is a portion of their property taxes. So they get help on the operating side of their ledger annually by paying less property taxes because they're getting some of it reimbursed.
I guess part I don't understand, if you build a building and it costs $61 million, and that you are paying taxes, and the taxes you are paying goes to paying back the $61 million. No.
No. The $61 million is their investment in the building. The bonds are proposed at
16
million. And that's based on the projection of 75% of the assessed value in the TIF that they will generate. So that's the size of the bond. So
the property taxes they'll pay on the 61 million, 75% of that is pledged to help pay the 16 million back, not the 61 million.
So the lion's share of it, they're paying up front anyway.
Absolutely. They're paying all of it up front. I mean, even the 16 million, they're going to take their own money, deposit it with the trustee, and then draw it down to help pay part of that 61.
That makes very good sense.
So how does that compare to giving them a tax abatement as far as which one is offering the biggest incentive?
This will provide a larger incentive because, as you know, for tax abatement, you're limited for real property. The tax abatement can go only out 10 years, and this incentive is lasting 17 years. But it's very similar when you're kind of looking at tax abatement because you're phasing in their taxes over a certain period of time. It's very similar here. You're kind of reimbursing them 75% of their taxes over 17 years. So it's similar.
That's helpful. Thank you.
Commissioner Tarantino, do I have your permission to ask if the audience has any questions? No. Okay.
Nosy member of the citizenry, Ed Yanis. I guess I'm trying to visualize how this would happen if they went on to phase 5 and jumped across the Brooks Drive extension. Would that have to be a separate TIF? Could they start a new one for the 25 years, or would that fall within the 2039 sunset on this one?
A couple things with that. First of all, across Brookside Drive, is that in the consolidated area? And it's in the consolidated TIF area, not this Boar's Head TIF area. Okay. To answer your question, Mr. Llanos, concerned citizen, if they were to do expansion number 3, 4, or 5, and it crossed out of their current County Road 400 tax allocation area into the existing allocation area, we could do what we did back in 2014, because that was also in the consolidated allocation area. We carved that out. We went through the amendment process, which includes the Redevelopment Commission, the Board of Commissioners, the Plan Commission, public hearings, to actually carve that boundary out and make it its own new allocation area for the project and start a new 25-year life. So as long as nothing else is happening out there, the Redevelopment Commission can make the findings that we're not adversely impacting outstanding bonds, and we could carve that out to create a new 25-year life TIF area for a new project that they might have.
Thank you.
Any other questions or comments? I will say that the City Council met last night for a regular public meeting, and I asked them to fill or nominate their person for the Economic Development Commission, and they nominated Mike Broyles. So at your public meeting tomorrow, this will be a topic. I will say, oh, I thought I was hearing myself, and that's not a good sound. Touche. Mike Broyles is the City Council's nomination for the county's Economic Development Commission. So the Economic Development Commission will be an item that I discuss with you tomorrow at your regular public meeting, where votes are able to happen if you also choose. That's all I have. And thank you again for coming together, both in person and virtually. I will say that if you have any questions about this, please feel free to let me know. If you don't want to let me know, I think you can contact them directly, because we want you to feel comfortable as we move through this process. And the old game show, no whammies, no whammies. That's I'm always looking for no whammies. And if I know about potential whammies up front, we can at least make an attempt to address those. Thank you again.
I would like to know if tax-wise and income-wise to the county, even obviously you can't probably give exact figures, but as these things are paid off, then the money that the county actually gets in taxes, say after 2034, whatever year it is, how does that change?
That is a good question. Once the TIF area ends, all that assessed value that the Redevelopment Commission is currently capturing that generates the TIF dollars, that will be added to the county's tax base to help reduce tax rates. So it doesn't really generate new money to the county, like in its general fund, but what it will do is it will help reduce tax rates and reduce circuit breaker losses. So you will get, in effect, net new revenues by the reduction in circuit breaker losses that you currently are receiving by the reduction in tax rates. So again, once the TIF area ends, the positive impact will be an increase in tax base and reduction in tax rates. And there will be new income taxes. We haven't really hit on that, but Corey mentioned, I think, 120 new employees. So each new employee that lives in Henry County, that will be key. Each new employee that lives in Henry County, that will be additional income taxes that you would receive, and then you'd receive your share.
I was reminded that the increment is the improvement. So the farm field prior to Boar's Head, so going back prior to 2014, the farm field, those taxes continue to flow to the normal units. The increment is captured on the improvement. And so it's kind of like but for, the but for clause, but for the incentives, and being in the right location, and having, and having an industrial park with utilities, and having land that was known to be for sale, that allowed them to make their investment. But the taxes from that farm field aren't captured. That's statutorily prohibited.
I used this analogy last night, and people kind of liked it, so I'll use it here, and you can tell me whether you like it or not. But because getting in taxes, it's not intuitive. It's not how you think they should be calculated. But kind of going to your question on how much revenue the county would receive once the TIF area ends, you think of like what the county, the county has a maximum levy. It has an amount that it can levy in property taxes, and it can't levy a penny more from what the state tells you. So let's say that what the county receives is $100 per year. You have one taxpayer. So that taxpayer would pay $100. So once the TIF area ends and Boar's Head would come into the tax base, now you have two taxpayers. Again, the county's budget's still $100, but instead of one taxpayer paying $100, now you're going to have two taxpayers paying $50. So again, as that assessed value adds to the tax base, it just reduces everyone else's liability. But the county still receives the same amount of revenue. I don't know if that helps or not. But.